inflation in the really strict sense is an increase in the broad money supply, especially on a per capita basis and compared to the amount of products and services in the economy. Now, that generally leads to broad price increases for goods and services, and that's what we think of as consumer price inflation. We can also have asset price inflation as well, which are generally not included in those consumer buckets. And so if you look at the ultra long term, like literally going back 150 years, broad money supply per capita and inflation, price inflation for broad goods tend to be pretty correlated, where when you have big increases in how much money there is per capita, broad money, not base money, but broad money, that includes currency in circulation, checking accounts, and savings accounts, that generally pushes up the price level of goods and services. And then, similarly, if you have periods of slow money supply growth, or in rare cases, decreases in the money supply, that tends to put downward pressure on prices. Velocity has a much more, a less correlation longer term. So generally, if you look back over 150 years, you've had steadily declining velocity with temporary periods of going up. And so, for example, you had very high velocity in the late 1800s, but inflation was very low due to massive productivity gains, things like that. Then you had, tons of inflation during the 1940s, but velocity didn't really change much compared to the prior decade. You also had high inflation in the 70s, but velocity was not really any higher than it was in the 50s or 60s. In the 90s, you had an uptick in velocity, but you did not really have an uptick in inflation. And so that correlation is somewhat weak, with the exception that if you have a deflationary shock, generally velocity goes down very briefly, and that tends to temporarily offset inflation. But if you stretch it out over the longer term, velocity is not one of, in my opinion, the best indicators. And so going back to that inflation versus broad money supply growth, that tends to be the correlation to look at. There's another period, for example, in Japan after World War II, they entered another one of those kind of economic miracle periods where you had a big increase in broad money, but because they were so productive, goods and services grew just as quickly, and so that really kept CPI low. Now, the 90s and all the way to present have been a more challenging period because in some ways we've had that where due to automation, due to offshoring, there have been productivity gains that put down wage prices and basically certain types of goods deflated in price. But on the other hand, that's been not even across categories. And so you've had education going up far quicker than official CPI. You've had healthcare going up far quicker than official CPI. You've had the median house price in the United States going up much faster than CPI. You've had, if you look at the Big Mac index, so the Economist tracks the Big Mac prices every year, and they do that for multiple countries. And actually, the reason they do that is because it's a fairly standardized item. It involves multiple commodities. It involves domestic labor. It involves energy, and McDonald's has to support their real estate, costs as well. And so it's actually kind of a very broad item that doesn't change very much. And so that's risen faster than CPI. That's risen faster than the food portion of CPI. And so basically, we've been in this environment where a lot of the essential expenses that people have generally, trended above CPI, whereas a smaller collection of things such as electronics and offshored goods have put somewhat downward pressure on kind of more discretionary areas. And so you've had this, kind of mismatch between what official models are saying versus what a lot of people are experiencing in the real world. And to compound on that, they've changed the way that the quality adjustments work. And a really good example of that is with cars. And so, for example, if you look at the price of a Toyota Camry in 1990 compared to 2020, it almost exactly doubled in price. If you look at, say, the automatic basic Camry versus the automatic basic Camry today, doubled in price. So 100% price increase. The official new car CPI says that new cars went up about 22% during that 30-year period. And so their way of calculating it is to say, okay, well, cars got so much better that even though they went up, they doubled pretty much on a per model basis, that if you factor out the fact that, they all have power everything now, you have a navigation system, you have better gas mileage, better safety features, so they go ahead and offset that. And so it's one of those things where I think a certain amount of offsetting is useful. I mean, it is true that they've gotten better, we put more into them, but I find it hard to bridge that gap between a 100% increase and a 22% increase. And if you then go back and say, okay, what is the the median number of, like, if you how many weeks does the median male income have to work in order to buy that car? It's about the same, give or take a week. And so, basically that's been one of the ways where the model says, okay, we've offset some inflation, but in reality, people are not feeling that because technology's made the car better, but not cheaper. I mean, I think, most fiat currencies are going to see that their purchasing power is going to go down over the next 3 years. And so that'll obviously depend on different rates. If you're in certain types of emerging markets, you might lose a ton of value. If you're in developed markets, you might lose a moderate amount of value during that, say, a 3-year cycle. And mainly it's because just whatever inflation ends up being, anywhere between 2 and 7%, let's say, that if you're earning 0 or 1% on that money, you're just getting, it's a melting ice cube, and it could be a quick one or a slow one depending on exactly where you live, but it's still a melting ice cube. Whereas, say, diversifying into things that are more finite is helpful. Now, the one area that currency might even strengthen against is the stock market. If you were to have, say, an inflationary event happen and then central banks try to cool back on some of that policy, then you could have the stock market roll over and start causing issues there. And so I think there's going to be a difference between, we've had this period of 10 years now where, we've been in this period of commodity oversupply. So every 15 to 25 years, we have these big, commodity capex cycles. And so, one of the things that has kind of suppressed inflation to some extent over the past decade is that we've been in this period of commodity abundance. And so many commodities, for example, are at a lower price than they were 10 or 15 years ago, with some exceptions. So lumber, beef, they went vertical. Gold touched new all-time highs in 2020. But if you look at, energy's been very low price. Copper, despite doing very well, still not at all-time highs. Many agricultural products are, they're on fire lately, but they're still not at all-time highs. And so we've been in this kind of, until this past year, we've been in this kind of commodity bear market. Now we're starting to wake up, but we're still not, soaring yet. And so that's kind of put, pressure on things. But as we go forward, if we go into the 2020s, there's an increasingly good chance that the commodity, complex as a whole starts going back up, and kind of, that even, some of these prices like lumber will ease, but that the broad commodity index is likely more in an uptrend now. And so that's, one of those things where you want to have exposure to things like that rather than being, say, purely in cash. And I agree with what you said before and what Rick Rule said, where, I hold cash, for example, as part of my asset mix. It's important for, managing liquidity, especially if you have expenses over a certain period of time. If you want to be able to buy opportunities, that if there's any kind of brief sell-offs or brief deflationary shocks or reductions in certain types of asset prices, it's very useful. But the main risk comes from people who are just, they're like all in on cash and bonds, and they're not realizing that they want to have, at the very least, some hedges against those positions.